Hi, I'm David Maurice Sharp, and I'm excited to be talking to you about financial literacy, particularly with regard to freelancers. So just to give you some idea of my background, I was a modern dancer here in New York for many years. I danced with people like Mimi Gerard, Lucinda Childs, Rachel Lampert, Anna Sokolow. As you're probably also aware, modern dancers are not some of the most highly compensated artists in this country. So I was always kind of looking for other ways to make money to get by and pay the bills. And a friend of mine suggested that I sign up for a temp agency because by working with them, I could sort of choose which days that I worked. I ended up being placed at this Wall Street firm. They actually interviewed me and accepted me, even though I knew nothing about Wall Street. And it was a firm that worked on things like corporate takeovers and proxy fights and tender offers and things that I knew absolutely nothing about, but was able to learn on the job. A great side benefit to that job, in addition to sort of a steady source of income, was that I learned a lot about investing, both with stocks and bonds. This was around the time that mutual funds were starting to become available as investments, which really kind of opened up the world of investing to many more people. Prior to that, you really had to have a lot of money in order to be an investor. So I started talking to a lot of artist friends who wanted to get involved in investing in mutual funds, but felt very intimidated about calling the companies because they felt like they didn't really know enough to be able to ask right kinds of questions. So we started working together. We ended up starting an investment group called the Thriving Artist Investment Club. We met once a month. We put in only $25 a month because we wanted to keep it inexpensive so that people didn't feel like they were really stressed. The main purpose of the club was to educate ourselves about investing. After about 9 years, we ended up disbanding because we were all kind of going in different directions. And we ended up making just over a 40% profit, which isn't bad for a bunch of artists who aren't really supposed to understand anything about investing. But it made me realize that a lot of the skills that we have as freelancers really lend themselves to investing and working in the financial markets and using them as a tool to sort of help our art. It's just that we have to find the right pathway into it. So that's some of the things that we're going to talk about today. Let me read the questions off and then I'll give you my responses to them. So the first question we have is, can you start by explaining what financial security means? How does it look different to a freelancer? So financial security, I always think of as not having to worry about where your next month's expenses are going to come from. Just understanding that you have your money under control rather than your money controlling you. It also means that if an unexpected expense arose for $500 or more, you wouldn't panic and say, I don't know where this is going to come from. You have the resources to actually say, you know what, that's okay. I can deal with this and pay this off. The way that financial security is different for a freelancer is that we don't really have consistent income, right? I like to talk about people who have the 9 to 5 jobs as the regular or the ordinary people, right? They have 9 to 5, they work 9 to 5, they're going to work until they're about 60, they're getting a pension or a 401k, then they're going to retire and sit on the beach, right? That is not our experience. Our experience is the feast or famine mentality, right? There are some months where we're working a lot and we have a lot of income coming in, and there are other months that we don't have so much income coming in. One of the things that I noticed is that there's a lot of really good information about investing out there. Unfortunately, virtually none of it addresses that situation that we find ourselves in, that sort of inconsistent income situation. So our job as freelancers is to first understand what they're talking about, right? And learning about financial investing and the financial markets is really like learning another language. First, you have to learn what it is, and then you have to figure out how to apply it to the situation that we find ourselves in. So it's kind of a two-prong approach. Next question. How much should a freelancer try to tuck away into savings? How does that number change if they have dependents? All right, again, for the ordinary people, they generally say you want to have around 4 to 6 months of living expenses tucked away as what I call an emergency cash stash. I usually say you want to have 8 to 12 months saved. Now, does that mean that by tomorrow you have to go out and have 12 months of your living expenses saved? No, it just means that that's a goal that you need to work towards. Why is that beneficial for us? Well, because again, we have this sort of fluctuating level of income. Having a full 10 to 12 months of living expenses can really give you a lot of peace of mind. And if you happen to have a long stretch of time where you don't have a lot of income coming in, it can help carry you through that. It also comes in really handy if, I don't know, we get hit with a pandemic or something where a lot of us can't work. So having that sort of cash stash of 10 to 12 months can be a really good buffer for situations like that. If you have dependents, the only way that it changes for you is probably your monthly nut or your monthly expenses are going to increase because you have expenses related to your dependents. So you want to figure out what all of that is. If a freelancer is starting from square one, no savings or investments, what would you suggest they do first? Very first thing I always tell artists and freelancers to do is to calculate out your monthly nut, how much it takes to get you through any given month. So there's a couple ways that you can approach that. One is you can just sort of list out all of your expenses in any given month, expenses like your rent or your mortgage payment, all of your utilities. You can just pick an average amount that you pay for utilities because I know for a lot of us they fluctuate from month to month. Groceries, entertainment. If you have a car, you want to figure out how much gasoline you put into it. If you have yearly expenses, a good idea is to just divide them out by 12 and assign a piece of that to your monthly nut so that you're saving up for that yearly expense. You also want to put in a category for investing in yourself. That's money that you want to put towards saving for your monthly nut and your emergency cash stash, but also money that you're going to start putting later on into other kinds of investments that are going to give you more bang for your buck. So you want to kind of add a little category. Now, by adding that category of paying yourself for savings, what you don't want to do is make it such a large number that you feel that you can't control it, right? Because if you go out of here and you're all gung-ho and you say, I'm going to start saving $3,000 a month for myself, the first month that you can't do it, you're going to think, wow, this really sucks. David's an idiot and I don't want to do this anymore. So start with a very small amount. If you're not currently saving anything, you might want to save $5, $10, then start to increase it so that you start increasing the amount you save. The big benefit to taking control of your monthly nut and understanding what it is the more cognizant we are of how we're spending our money, the less we tend to spend. Another way to go about calculating out your monthly nut is you could just take a month and record every expense you make. Just take a little notebook with you, or at the end of the day, just write down everything that you spent money on. The other thing that can be really helpful with is it's going to show you some things that you might be spending money on that you weren't aware of how much money you were really spending. One of the things that I always tell people to look at is these days, how much are you spending on streaming? Because we get all these offers for streaming, right? Of, oh, it's only $1.99 a month, it's $2.99 a month. And pretty soon, if you have 10 of those, it's starting to add up to a lot of money. The other big expense that people often find when they're recording their own expenses are things like Starbucks. Like if you are in the habit of getting that mocha frappuccino every month, it's surprising over the course of a month, or every day, it's surprising over the course of a month how much you've actually spent. So again, being aware of your spending will really help you, and calculating out that monthly nut is a great foundation getting started on building your financial wellness plan. What investing goals should a freelancer set for retirement and wealth building? All right, I usually divide investing into three main categories, and these make up what I call the core portfolio, your core portfolio. The first lowest level of investment are your cash investments. And this is where you're going to keep your monthly nuts and your emergency cash stash, right? Think of the cash part of your portfolio as the ballast of your ship. It will keep everything sort of steady because there's very little fluctuation. Now, what makes something a cash investment? There's one rule that I like to give, and that's $1 equals $1. The idea behind that is if you take $100 into your local bank and you put it into a savings account, you go back a year later and say, hey, I want to take this money out. The teller is not going to say to you, okay, well, with the fluctuation of the dollar in the market, it's only now worth $90, right? A dollar equals a dollar. Put $100 in, you're going to take $100 back out. There's no fluctuation of the dollar unit as long as it's within the closed economic system of the United States. If you compare it to foreign currencies, there is change, but we're just looking at the bubble of the United States, right? That's what makes cash so steady. It also makes it have very little reward, right? And if you look at the interest rates we're getting, we're not getting great interest rates, although they are starting to go up a little bit, but you don't typically get a lot of return on your cash. That's not its purpose. Its purpose is safety, the ballast of your ship. So again, that's where you want to keep your emergency cash stash of 10 to 12 monthly nuts. The next level up is a category called bonds. Bonds are basically a loan. You own a bond, you're agreeing to loan money to an organization or an entity. They're agreeing to pay it back to you with interest after a certain period of time. Typically, there's also, if it's a bond that is a longer term bond, there's going to be regular 6-month interest payments on that. That's why bonds are also sometimes referred to as fixed income. But because bonds have a date on which they have to be paid back, that makes them a little bit less risky and a little less volatile on the trading markets than the top level of our core portfolio, which is stock. Stock basically represents ownership in a company. If you own shares of stock, you are an owner of that company. That means that if the company has profits that it distributes out, they will be distributed to you in something called a dividend. The price of stock trades constantly on the market, which makes it the most risky, but also historically, it's proven to be over time that stocks have the best return. So what you want to do is you want to sort of balance this core portfolio by adding these bonds and stock elements to it to try to give yourself a little more bang for your buck. The other thing I tell people that I like them to sort of keep in mind is that often we think of investing in things like bonds or stock as kind of throwing our money out into an abyss, this dark abyss that we don't really know anything about, and we sort of keep our fingers crossed that at some point it's going to come back to us and we're going to get a little bit of something for it, right? Instead of that, try to change your thinking so you look at investments in bonds and stock as your employees. So these are employees that are going to be working for you constantly. They work 24/7. You never have to listen to them complain. You don't have to feed them. You don't have to give them vacation. They're just sitting there plugging away, earning hopefully money for you over the long term. The other thing that you want to think of your emergency cash stash for is that it's a buffer so that you can use that instead of having to sell some of these assets if the market is down, right? So you always want to find that balance. If you tend to be someone who doesn't like to take a lot of risk, you might invest more of your extra money into bond investments rather than stock, which is the most risky. Or if you feel like you're a little bit more on the risky side, you could put more into stocks. The easiest way to invest and get exposure into bonds and stock are through mutual funds. Mutual funds are basically a collection of assets, and you're just buying a piece of everything in that basket. The great benefit for mutual funds is, number one, they're really easy. They're very easy to buy. You just go to a mutual fund family. Some examples of them are Vanguard, Fidelity, Charles Schwab, T. Rowe Price. Those are all fund families that you can find different kinds of mutual funds that you can invest in. The other great thing about mutual funds is they give you instant diversification. Diversification means not putting all of your eggs in one basket. So if you buy shares of a mutual fund, you actually own a fractional piece of everything in that basket of assets. So that can be a really great way to build wealth. Now, at the same time, because a lot of us aren't going to be covered by 401ks or pensions or 403bs, we also want to be looking towards building assets towards retirement. Usually that will take the form of something called an individual retirement account or IRA. The great thing about IRAs is they're like a bubble that you put these mutual funds into, right? While they're in that bubble of the IRA, everything, any earnings that they make, whether it's dividends or interest payments or capital gains increases, they are not subject to taxation. So you want to try to protect some of your assets in those retirement accounts. The downside to that is that if you take them out prior to reaching the age of 59 and a half, you're subject to a big penalty on it. So you really need to think of those funds as being sort of tucked away until much later in life. So generally what I say to people is, okay, how do you decide what to do? Do you save up for your monthly nut and your emergency cash stash? Do you invest in regular investments outside of retirement? Do you invest in investments in assets inside retirement vehicles? What do you do? A little bit of everything. I like to say it's like rolling a lot of little balls up the hill at the same time. You put a little bit into each one so that they're all growing simultaneously. Why do I feel I never have enough in savings? How do I move to the next goal? So again, and this is not uncommon that we all say, gosh, I never have enough. Now we know what our goal is, right? Our idea is to have, we know how many, we've calculated out our monthly nut, know how much it takes to get us through any given month. We know we want to have 10 to 12 months of cash in our emergency cash stash. How do we build it up and keep it growing? The best way to do this is to automate your savings. And you can do this by, right now there's a lot of online high yield money market accounts that are federally insured, FDIC insured up to $250,000. If you can set up one of those, or if you have a separate savings account, one that you don't normally look at every day, that's kind of separate from the bank account that you use to pay your bills and everything else, it's a great idea to set up an automatic monthly transfer from your regular checking or savings or the account that you use all the time into this special high interest account. Even if it's $10 a month, start doing that. You're going to be surprised at how quickly you can accumulate that extra cash. Plus, you'll benefit from the fact that it's paying a much higher interest rate because it's in this one of these high yield money market accounts. Shouldn't I prioritize things like buying a house over saving for retirement? Again, if your goal is to buy a property to live in, a house, apartment, co-op, condo, what you want to do is, if that's your goal, is make sure that the funds that you're saving for that house are not put into investments that could be suffering a loss at any given time. So that means you're going to want to focus the funds that you're saving for the house into something like a money market account, which you, again, know is not going to have very much return. I would still continue to build, at least on some level, investments in bonds and stock. The reason being is, over time, they're going to give you more bang for your buck. But also when you go to get that mortgage, showing that you have assets in addition to the down payment for the house is going to really work to your favor in terms of getting a good mortgage, right? If you know you have a 2 to 3 year timeline, you might want to look at putting some of that cash into something like a certificate of deposit, which is going to carry a penalty if you withdraw it before the term of the certificate of deposit, or CD. But if you know you have the time and you're not going to need that money, you might get a little bit more interest for it in the meantime. How do I budget for savings with an unpredictable income? When I follow the rules of thumb percentages, I end up having to take some back out later in the year. My favorite way to sort of organize how you deal with the feast or famine mentality is by doing something I call pay yourself a paycheck. What I do is, anytime I get paid from any kind of employment, no matter what it is, any payment that comes in, I automatically throw that into my savings account. So all the money is just getting accumulating in the savings account. Once a month, I pay myself a paycheck. The amount of that paycheck is my monthly nut. So what that means is, and the monthly nut obviously is covering all my expenses, so I move that from my savings account, I pay myself the paycheck into my checking account, and then I go about paying all of my monthly expenses. What it does is it sort of tricks you into being like an ordinary person, in that you're always getting the same amount of money that you have to pay your bills. So you're not seeing this big wad of money come in where you say, oh, I've made so much money, I can spend all this extra money, because you're actually sort of making yourself stick to the amount of your monthly nut. In the months then that you bring in more money into your savings account, you're going to accumulate those extra funds in your savings account so that you can use them in the months where you don't quite make enough to cover your monthly nut. But you know that they're there. It will also really start to build up the savings in your savings account. And then you can start moving some of that into one of these high yield accounts, so it's kind of out of sight, out of mind. What you don't want to do is ever see this big blob of money and think, oh, wow, I have all of this money. If you think about that emergency cash stash as being, okay, these are, yeah, that looks like a big blob of money, but it's actually only 3 monthly nuts. So I need to build up more. It helps, again, prevent you from doing that. But this pay yourself a paycheck method really works. I've had so many people that have been in my classes that have come back years later and said, you know what, I did the pay myself a paycheck thing, and it's unbelievable how much money I was able to save. So give it a try if you haven't. Hopefully this has been really helpful for you. I look forward to hearing if there's other questions that arise from it. Again, my name is David Maurice Sharp. I have a book out called The Thriving Artist, which is geared towards financial information geared specifically towards artists and other freelancers if you're interested. You can also find information about me on my website, which is davidmauricesharp.com. That will also list other classes that I teach at various locations. So I hope this was helpful. I hope this has inspired you to sort of take control of your financial wellness and to realize that it really is something that you can do for yourself. So get out there, take control of your finances, and thrive.